The way generations before you got rich doesn't work anymore. What your parents told you about money is outdated, and what your professors told you to do is just wrong. And in this video, I'm gonna go over how you can get rich in this new economy, even if you don't want to make YouTube videos or dance on TikTok. Yeah. Oh, sorry. The old way to get rich was go to school, get a job, climb the corporate ladder, and save 10% of your income. If you graduate school making $40,000 a year when you turn 21, and now you save 10% of your income, which is $4,000, and you continue to do this for 45 years until you turn 66 and you save $4,000 a year, well, when you turn 66, you are going to have $180,000 saved up from your $4,000 saving every single year. Now you might be thinking, but Jaspreet, I'm going to make more money when I'm 66 than now. What about my raises? Well, let's assume now that you get a 3% raise every single year. Now you graduate school making the same $40,000 a year, and when you're 21, you're going to save $4,000. Now every year you get a 3% raise, which means by the time you're 66, you're going to be earning just under $147,000 a year, which also means that you are going to be saving about $14.7 thousand. If you follow this plan, you are going to have $370,000 saved up for retirement. The problem with this is this isn't enough money. If you retire with $370,000 and you were making $147,000, well, this money is only going to last you a few years. Not to mention the fact that you had worked your entire career to hopefully start enjoying your life. But now you can't because you don't have enough money. Now you might be thinking, but Jaspreet, what if I don't just save my money, I invest my money? I have a 401k. Doesn't that mean that I'm okay now? Well, the problem with that is, well, for the vast majority of people, your 401k will not be enough for retirement. Even the founder of the 401k has come out and said that the 401k has gone awry because you have so many people saying that I'm going to rely on a 401k to retire when your 401k was never intended to be your sole retirement plan. Back in the day, this system worked just fine. Like in 1970, most Americans had a one-income household, which meant that typically the man went to work and the woman didn't. And in that system where you had one income, you were able to buy a home comfortably. You were able to buy a car comfortably. You were able to live your life comfortably. And this system helped fund your retirement. Now, sure, you had other things like pensions around back then too, but today, this system is obsolete. And I remember when I was in high school, we never really talked about money, but my math teacher did talk about money one time, and he was talking about how you could get a great return on your money if you put your cash into a high-interest CD, certificate of deposit, talking about how they were great investments. That was the only exposure to how to grow my money when I was in school. Now, for those of you who don't know, CDs are horrible investments for your money, but we'll talk about that in just a little bit. Now, if you want to be rich or if you want to be wealthy, whatever you want to call it, the first thing you have to do is define what this means. If you have $100,000, are you rich? Are you rich if you have $1 million? Are you rich if you have $10 million? What is it when you're rich? And the best definition that I have found on this is rich or wealth is a measure of time. $100,000. If you have 100 grand, does this mean you're rich? Well, if your annual expenses are $50,000 a year and all you have is 100 grand, you're rich for 2 years. After that, you're broke. If you have $1 million and your expenses are $100,000 a year, are you rich? Well, you're rich for 10 years. After that, you're broke. If you really want to be financially free, now what you need is you need assets greater than your liabilities, meaning you need investments that cover your expenses. When you have enough income from your investments, meaning you don't have to go to work to get paid, your investments are paying you more than what your expenses are, now you have infinite richness, because if your expenses are $5,000 a month, but your assets are paying you $6,000 a month, now the time is infinite because you keep getting paid and you can keep living your lifestyle without having to worry about money. This is true richness, financial freedom. Now, for everybody watching this saying, oh, but Jaspreet, money doesn't matter. You shouldn't talk about being rich like that. Look, I get it. Money is just one part of our lives, but it is an important part of our lives. In this video, I'm going to be focusing on the financial side of being rich. Of course, you got to have love in your life. Of course, you have to be healthy. Of course, you have to be happy. All these things are important, but today we're talking about the financial richness. So how do you do it? How do you achieve that level of richness where you have that true financial freedom? Well, it comes to the term equity. And when most people hear the term equity, what they think about is the equity that I have in my home. This is what the majority of people think of when they hear the word equity, when in reality, that is the worst kind of equity out there, because equity is how people get rich. But you never hear of rich people talking about how I got rich because the value of the home that I live in went up. That equity in your home only has value when you go to sell your home. And now, if you sell your home for a profit, that equity is valuable. If you sell your home for a loss, well, you don't have any equity. And in addition to that, and in order to get this equity, you have to sell the home that you're living in. But for the purposes of this example, let's talk about now the real ways where you want to focus on getting this equity. Because if you own something that's paying you, now you have an asset, you have equity that can allow you to live this true richness. Now you can build this equity or you can buy this equity. Those are the two ways that you can get this equity. I'm going to explain what that means in just a second, but you can build it or you can buy it. So if you go back to what I was saying in the beginning part of this video, the traditional way of getting rich was you go to school, get a job, and climb the corporate ladder. But that focuses not on equity, that focuses on labor. You go to work to get paid. And the reality is, well, we've been seeing a growing wealth gap and people's incomes have not kept up with inflation. What does that mean? The median salary today does not buy you what the median salary could a few decades ago, and this is going to continue to get worse. People's incomes from their jobs are no longer cutting it. That's why today, unlike 1970, most households are now two-income households, and even though you have two-income households, people are still struggling to buy a home. People are still struggling to get a car, and people are still struggling to save for retirement. Your labor will not be enough. That's a fact. And in addition to that, the value of people's salaries are eroding because of inflation. That's also a fact. And the third thing is that wealthy people and rich people never talk about how they got rich from this. They talk about how they got rich from this. They talk about how I own a business. They talk about how I own an investment. I talk about how I own an asset. And these assets are the reason why rich people are rich. What do the majority of people talk about when they talk about equity? They talk about having equity in their homes. No rich person talks about how they got rich because of the equity in their home. They talk about how they got rich because of the equity in something else. A stock, a real estate, a business, something else. Now, you don't need $1 million to go out and do this. But you have to first understand the system. You can start with as little as $100. But you have to understand the difference here, because what wealthy people are doing is they're taking the money from their labor and they're putting it here. Now again, there's two different ways to create this equity, to own this equity. You can build the equity, which really just requires more time than money, or you can buy the equity. This is where now every time you get paid, you're going to be putting in money to own this equity. The difference between these two is here you get paid for what you do. Here you get paid for what you own. Wealthy people are looking to grow this because there's a limit to how much you can do. There's a limit to how many hours you can work. There's a limit to your pay raises. There's a limit to all the effort that you can put in at your job. And again, you can build it or buy it. So let's start by talking now about if you were to build it. I am the founder and CEO of a company called Briefs Media. We are a newsletter company. We have free newsletters for investors called Market Briefs, and we have a free newsletter for entrepreneurs called Business Briefs. And in this newsletter company, I get paid as the CEO, but my salary is pretty small. However, I also get paid equity, which is the ownership in the company. Now, I didn't have to go out and buy this company because I was the one that created it. I started this company from scratch and we worked to slowly grow the company. Now, here, I only get paid if the company makes money. If the company makes a profit, I get equity. I get the distribution. I get the profit because that goes to the owner. This is a salary. This is what I get paid for working in the company. This is what I get paid for owning the company. Now, the reality here is that not everybody should be in the business of starting a company. Not everybody should be in the business of operating a company. However, everybody in America should be in the business of owning a company. What do I mean? If you're not going to build it, then you buy it. as a passive investor. See, building a company, building this type of equity takes a lot of work. It takes a lot of stress and it takes a lot of risk. Not to mention all the time, the effort, the education, and everything else. You have to be an entrepreneur to actually build it, and not everybody is meant to be an entrepreneur. Not everybody should be an entrepreneur. Everybody's glorifying entrepreneurship with social media, but the reality is it's really not as glorious as people make it seem. It's a ton of work. It's a ton of stress. Yeah, you get all the upside, which is great, but you have to be willing to go through all the hurdles, and most businesses will fail. Now, if you like the idea of being an entrepreneur, then yeah, go out and build it. Now, you can build this own equity for yourself. If you don't want to build it, or you're not interested in building it, then the next alternative is buying it, because you can buy this equity as well, and you don't need a ton of money to start. Buying this equity would be now you taking your money and you're putting it into the stock market and buying companies or ETFs or index funds on the stock market. Now you're owning a piece of the companies, and the more you own, the more equity you have. When your companies or investments grow, so do your investments. If you see them go down, you'll lose money. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own due diligence, and never blindly trust a random guy on YouTube. You can buy equity by investing in real estate. And when I say investing in real estate, I don't mean buying a home to live in yourself. I mean buying a rental property that you can rent out to other people, because now you're buying a home not to live in, but to make money. And so you're going to analyze the deal very differently. And now when you buy a rental property, you're getting paid while you own the property. With your home, you only get paid if you can sell your home for a profit at some time in the future. With a rental property, you're getting paid every single month. Now, while this system of labor versus equity has always been around, it's becoming so much more important in this new economy because people's labor, people's salaries are not able to keep up with inflation and the growing cost of living. This is a fact. The cost of living is growing faster than people's incomes, which is why this becomes so much more important. Buying equity has always been around. Sure, investing in the stock market is so much more accessible now than it was 30 years ago, but it's been around along with real estate investing. Now, this is what's really changing in this new economy as well, the way you build this equity, because the reason why people talk about YouTubers and TikTokers and all that is because attention is the name of the game in this new economy. If you can secure someone's attention, you have the ability to make money, period. That's why you hear of so many YouTubers making a lot of money. You hear of TikTokers making money, because when they grab your attention, now they have the ability to sell something, market something, show something. Every single business in the world has something to sell. Period. Now, when they sell something, how do they do that? Traditionally, is through commercials, is through your traditional billboard advertisements, your traditional radio advertising. They wanted to get your attention somehow, but that was a form of disruption marketing. You'd watch a TV show, and then you'd be disrupted with a commercial, and now you watch a commercial that you may or may not want to watch, but the commercial advertisers are going to do whatever they can to try to get you to want to watch the commercial. That way you can see the advertisement to buy a product. Nowadays, it's flipping, where advertisers are saying, oh, we can pay somebody on social media who already has this attention, and then they can integrate our products into their pitch. This is why you're hearing of so many social media people making a lot of money. Again, I'm not saying that you need to go on social media and do that, but what I'm saying is understanding that attention is the name of the game. If you can have a business that grasps people's attention, now you have the ability to either sell more of your own product or sell more of somebody else's product. Like Facebook is a great attention gatherer or grasper. It gets your attention. Now, they don't sell their own product. Facebook doesn't have something where you pay $50 a month to use Facebook Pro or Facebook Premium. At least not yet. What they do is they show you advertisements for other people's products. When you have somebody's attention, now you own the media, and now you can sell either your own product or somebody else's product. And this is where now you have the ability to grow and scale your brand because you have that attention. Every business in this economy is trying to grab somebody's attention. And if you can figure out how to grab somebody's attention, well, now your money-making potential is limitless, because now either you can sell your own products because you have that attention, or you can sell somebody else's products. Now, of course, if you are an entrepreneur and you want to stay up to date on these types of innovation trends and business trends, you can join Business Briefs. It's free. If you want to learn more about that, I got the link to how you can join down in the description below. Now, I know this makes a lot of people angry, but again, I'm not here to make friends. I'm here to help you learn. Part of this education is building that discipline to understand how you use your money when you get paid. Poor people, the middle class, and rich people use their money when they get paid very differently. And so now if you want to become wealthy, the first thing you have to do is